Ever wonder why the price you pay for gas or even your morning coffee seems to be on a roller coaster? Well, a huge part of that story is a financial strategy that's been around for centuries. It's called commodity hedging.
I mean, that's a pretty big question, right? We all think about it. But for some people, it's not just some late night thought experiment.
For them, a future you can't predict means prices you can't predict. And that, well, that can be the difference between a great year and going out of business. So how do they deal with that kind of risk? That's exactly what we're going to break down here.
All right, here's our game plan. We're going to start with the basic problem, wild prices. Then we'll look at it from two different angles, the producer side and the consumer side. After that, we'll get real about the challenges, and then we'll wrap it all up with the single most important takeaway. You know, any business that grows, makes, or uses raw materials, we're talking everything from soybeans to crude oil, they all crave one thing above all else, stability. They want to know what their costs and revenues are going to be. But commodity markets? They are anything but stable. And that's the core conflict hedging was invented to solve.
So what exactly is hedging? The best way to think about it is like financial insurance. This is not about speculation. It's not about rolling the dice and hoping to make a killing. It's actually the complete opposite. The whole point is to take risk off the table by locking in a price today for something you're going to buy or sell down the road. And you know, this isn't some newfangled financial product. The idea is ancient. It started with simple handshake deals between farmers and merchants way back in the 1800s. It just got standardized in 1865 at the Chicago Board of Trade, and today it's pretty much the backbone of our global economy.
Okay, to really get this, let's walk through a classic example. Let's meet our producer, a soybean farmer. Her number one fear is simple. She's worried that between planting her crop and harvesting it 6 months from now, the market price for soybeans is going to completely tank, and all her hard work will be for nothing. So she runs the numbers. She knows she needs to get at least $10.10 a unit just to make a solid profit. So what can she do? She can use what's called a futures contract to essentially sell her future harvest today, at today's price for that exact $10.10. This move is called a short hedge. Okay, now let's fast forward 6 months and see how this plays out. Scenario 1, the market price skyrockets to $13. Great, right? Well, she sells her actual soybeans for a high price, but she loses money on that futures contract. But look what happens when you balance them out. Her net price, $10.10. Now, what if the price crashes to $7.50? Her physical crop is worth less, but her futures contract makes a profit, perfectly covering the gap. The net result? You got it. $10.10. And that right there, that is the magic of a good hedge. It doesn't matter if the market goes crazy up or crazy down, our farmer got the exact price she needed. Now sure, she gave up the chance to make a windfall profit if prices went to the moon. But in exchange, she completely eliminated the risk of a devastating loss. She chose certainty, and that's exactly what she got. All right, so that's the seller's side. But let's hop over to the other side of the deal, because for every seller worried about falling prices, there's a buyer worried about rising prices. So let's think about a company that manufactures soybean oil. They need to buy those soybeans. This manufacturer has the exact opposite fear of the farmer. They're terrified that soybean prices are going to skyrocket, which would wreck their production costs. So they do the opposite move. They buy a futures contract today, locking in their purchase price at, you guessed it, $10.10. This is called a long hedge. And just look at this. It's a perfect mirror image of the farmer's situation. If the price jumps to $13, yeah, they have to pay more for the physical beans. But their futures contract makes a profit that cancels out that extra cost. Their net cost is $10.10. And if the price falls, they lose a bit on the futures contract, but they save a ton on the actual soybeans. The final cost? Still $10.10. It's beautiful. So let's just put it side by side, because this is the whole shebang. You have two different businesses with two opposite fears. The producer sells futures, goes short, to protect against falling prices. The consumer buys futures, goes long, to protect against rising prices. They're using the same exact tool to create their own little pocket of stability in a chaotic market. Now, I know what you're thinking. This sounds almost too perfect. And you're right. In our clean little example, everything works out perfectly. But in the real world, hedging isn't quite so simple. It comes with its own set of very real challenges.
First off, there are some pretty big financial hurdles. You can't just snap your fingers and do this. You have to put up cash up front, called margin money, just to open a position. And if the market starts moving against you, you can get something called a margin call, which means you have to pony up even more cash, fast. And let's not forget the big one, lost opportunity. Hedging by definition means you give up your chance at that surprise windfall profit. And then you've got logistical headaches. Futures contracts are standardized. A coffee contract, for example, might be for exactly 37,500 pounds of a very specific grade of bean. What if you're a small craft roaster and you only need 10,000 pounds of a different kind of bean? The financial tool doesn't perfectly match your real-world need. That gap creates its own kind of risk. So, after wading through all those real-world complexities, what's the fundamental lesson here? What is the absolute core principle of doing this right? This quote just says it all. The moment a hedger starts thinking, ooh, maybe I can get lucky and make some extra money if the market moves my way, they've lost. That's not hedging anymore. That's speculating. The real goal is purely defensive. Remove the price uncertainty so you can focus on your actual business, whether that's growing beans or making oil. So when you boil it all down, it's a simple 4-step process. Step 1, figure out your risk. Are you scared of prices going up or down? Step 2, find the right tool to take the exact opposite position. Step 3, pull the trigger and lock in your price. And step 4, achieve the goal, which is always certainty over speculation. And that really leaves us with the central question, the one that every single business, and maybe even all of us in our own lives, has to answer. Hedging is a powerful shield against risk, there's no doubt about it. But is that peace of mind, that security, always worth giving up the chance for a bigger win? That's the trade-off at the very heart of it all.